Yo, what is up, everyone? My name is Dom, and we're not here to talk about unusual options activity. We're here to talk about a hedge that I put on because I'm trying to talk about volatility and the volatility index real quick and give you guys maybe a nice little hedge that you can put on, something that I put on. Now, a hedge is something that a trade you would put on to protect your portfolio from downside risk or from volatility. So this isn't something that you put all your money in. It's just something you set aside a little money, you buy some protection. It's pretty much like buying insurance. You're hedging the profits that you have now. You're putting down a little money in case things fall, then you can make money on that hedge. You lose some profit on your stocks, but you can make some money on that hedge. And if the markets keep going up, then I'm going to explain why this hedge that I have here is the best, in my opinion. So this is the VIX. This is the volatility index. This is just people call this the fear gauge. This is just pretty much market sentiment. Some people say it's pretty much just a ratio of put to call ratio on the S&P 500 stocks. So if people are buying a crap ton of puts, this thing goes way up. So as you can see here, during the COVID-19 crisis, when all this hit like March, this thing went from like 11 to 85 because market volatility was through the roof during the March crash. If you look at the S&P 500, it's pretty much the S&P 500 is this inverted. The S&P 500 started here, came crashing down. So I like to put this hedge on, and what I did is I just did a cheaper hedge surrounding this election coming up, this Georgia runoff. I think there's going to be some volatility surrounding it, especially if we do end up getting a blue wave. I don't think the market is pricing in a blue wave at all, and I think that stocks could have quite a bit of a correction if the Democrats do win. Because historically that's just what happens. When there's a blue sweep, the market tends to correct right away, and then it will gain some steam after that. So as you can see here, with the past election, there was a huge spike in volatility, and then this was the day after the election. It just came crashing down after the election. Now, this isn't the presidential election, but in my opinion, this is just as important, and I don't think we're pricing in the volatility in the market for this Georgia Senate runoff. If the Democrats win, then it's a blue sweep. If I think this is even more important than the presidential election, and I don't think the volatility at 22 is getting priced in here. So that means I think that I'm not saying the volatility is going to get to 85. I think it could get up into the 30, maybe mid 30s. So my positioning reflects that. Now what I did is I got the June 20th 25-40 call spread. So I bought the 25 strike and I sold the 40 strike against it. So remember, guys, with a vertical spread, that's what this is called. The maximum amount of money that you can get back from this trade is the difference between strikes. So I can get back 40 minus 25, 40 strike minus 25 strike. So times 100, because every contract is 100 shares of the VIX. So yeah, 40 minus 25 is 15, so 1,500. I think I paid about $1.90 for this. So I paid $1.90 for something that can go to 15. Now, it has to get a way above this 40 strike for it to be worth that $15. But it's just a hedge that I put on, saying that volatility is going to increase, and I went with this January 20th expiration. Just because the Senate race is next week, Tuesday or something, and a lot of these contracts are traded here. If you go to some of these other ones, it's not really there's not really a whole lot of volume. So I just went with these January 21s, and I did a spread here to mitigate some of the time decay in case I have to hold these for a week or two. As you can see here, theta time decay we bought this one, so we're losing $7 to time decay every single day, but we sold this one against it, so we're collecting $5 in time decay every single day. So net here, we're losing about only $2 to time decay, versus if I bought this January 2025 strike, we'd be losing $7. When I do the spread, I'm losing $7 here, but I'm also gaining $5 here. And remember, you multiply these numbers by 100 because every contract is 100 shares. So $7, $5. Now I could go on for probably about 5 hours talking about the volatility index and how it's, you can't actually buy stock here, you can't trade it. It's pretty much just a measuring tool. There's a lot of stuff about volatility. I don't want to be going too into the weeds here. I just thought I'd share you guys a good cheap hedge that I put on, in case we're going to get some volatility within, this week, next week, the week after. These expire January 20th. I believe that's Wednesday, a few weeks from now. So, in case we see a nice correction, the volatility index goes up when markets go down. So I'm not sure if I said that at the beginning, but yeah, that's really important. So, all right, guys, yeah, make sure you leave some comments down below if you want to know more about the volatility index. I'll definitely do a whole video on it. So yeah, please let me know in the comments down below if you're confused about anything. Definitely down to answer some questions on this one. There's a lot surrounding this topic. So thanks for tuning in. Make sure to like, subscribe, and comment, and we'll see you guys in the next one. Happy New Year, everyone.